Welcome back to the Retire Young radio show. I am your host, Joshua David, having some fun with my good friend, my good pal, and he is drinking a lot of coffee today, Mr. Al Connickson. Al, as we get into this next segment here, I mentioned retirement, and that is a goal of everybody at one point, and everybody wants to dictate that future. Nobody wants to retire when they have to. They want to retire when they want to. Now, there's different techniques and strategies that the institutions are using. I mean, you hit the nail on the head in the first segment. They're putting people that they're managing their accounts into something different than what they're doing. So let's continue that discussion on that disconnect, why they're doing so many different things in retirement accounts, or why they're just putting people in that buy and hope strategy, and the different techniques that we can also use in our retirement accounts.
Yeah, one of the reasons, Josh, is that, as I mentioned before, futures is a short-term trading vehicle. Forex can be used short-term, options, the same thing. And most financial advisors have way too many clients to be able to do that, to be able to manage that on an ongoing basis. So it's much easier for them to put people into a mutual fund or some kind of maybe a prescribed or described portfolio, maybe one that's a value, maybe one that's growth, maybe one that is for income, and maybe with hundreds or thousands of other people in that same portfolio. And then they just kind of, what's the word I'm looking for there? They recommend. It's one of those high-tech words.
Can you spell that?
Later, I'll spell it.
That's better than that word peculiar you tried to say last time.
That's right. But anyways, they'll recommend a long-term type portfolio. It's a great business model for them, but to their benefit, I guess, is it's not really their fault because they just have too many people to be able to do this. But think about it. You can look at your accounts. You can manage your assets on a daily or weekly or monthly basis easily. And the typical Wall Street client has maybe a couple, maybe sometimes one, maybe two or three, or sometimes 0 meetings a year. And think about it. If you have a garden or a yard, can you water it once or twice a year and have it grow?
I highly doubt that.
Probably not. Maybe you should look at your portfolio the same way. And as an individual investor, we have the opportunity to do that. And we have the tools, the resources, the education is all there for us now, along with a high-speed internet. But we started talking about futures and the fact that you can still trade in the stock market. You can trade commodities, oil, gold, silver, currencies, interest rates, a number of different things, almost 24 hours a day. The foreign exchange market is where you're looking at the difference in exchange rates between two different currencies, trading it as a pair. That does trade 24 hours a day. And then options, you're trading options as a contract on something else, on an underlying, like stock or an exchange-traded fund. You can do options on futures and Forex trades. But they're all, not only can they be used on a short-term basis, but futures and Forex trade 24 hours a day. They have leverage, and that's the big advantage. That's one of the reasons that the pros use it, because it maximizes their purchasing power. If you're putting together portfolios based on individual stocks, it can require a lot of capital up front. With these leveraged assets, you can control contracts that are much more valuable than the initial investment, and that's where that leverage comes in.
So what is that leverage, like 10 to 1, 50 to 1?
Yeah, it varies depending on the asset. Like within the options markets, they look at maybe beginning at a 10 to 1 leverage. With futures, 20 to 1, could be close to 100 to 1. With Forex, 50 to 1. But basically what it means is that you're just maximizing the power of every dollar that you have. Now, it's also very important to have a risk strategy in place. And one of the things that we do, and it's helped by a trading and analysis platform that we have our students use, where the number one thing that they enter into it, because they personalize it for them, is the amount of risk that they are willing to take on any individual trade. Maybe it's $100, maybe $50 or $200. That platform then will tell you if you are trying to put together a trade or investment that exceeds that. It's going to tell you that, hey, you're exceeding your risk level. You might not want to do that. But the leveraged assets are used by Wall Street on a regular basis. And like with anything else in life, the best way to learn and excel at anything is to follow the people that are already experienced. Is Wall Street experienced? Yeah. You're either with them or against them. And since they trade 80% or control 80% of the trades in the markets, why not trade with them? Why not just do exactly what they're doing? You can use the same assets that they're using, and that's part of a plan too. The asset and the strategy you use should be specific to you. Everybody has different goals, different expectations, and the asset that you use should, reflect that. The strategy, the foundational strategy, should be the same no matter what asset you're using and what time frame you're looking at as far as your investments.
You're exactly right. Everybody's in a different stage of life. So, a person that's 30 is going to have a different plan than someone that's 50. Someone that's 50 is going to have a different plan than someone that's 65. So that way, when you are able to understand to manage things properly, in the proper assets, then you have more confidence. And that's what it all comes down to, is one of those three C's, having more confidence. And you mentioned having that garden. I mean, a portfolio is kind of like a garden. You have to water it daily or monthly, whatever that strategy is. Okay, Al, so we've been talking about retirement plans and the opportunities that are available to us. Now, most people think, well, how am I supposed to do that? I have a 401k or I have an IRA that is managed by a broker or an advisor. And by the way, we're not talking bad about the brokers. It's the system that's been challenging for a lot of people. So how can investors break away and manage it themselves? It's called self-directing. And we have the ability to self-direct our own accounts. It's just putting into a separate account. And then you make your your own decisions. And it's all about having the confidence to do that, Al. Let's talk about how you're helping people with the confidence to self-direct.
Well, people are actually already self-directing their retirement accounts. If you have an employer-sponsored retirement plan, and we talk about this every week, Josh, but you're actually making all the decisions. The plan sponsor is saying, okay, here is the structure of our retirement plan. You have these choices, and they give you a list of maybe mutual funds or exchange-traded funds. And now you make the choice. You decide which ones you want to go into. If there's any changes to be made, you decide which ones to change into. You mentioned when we were talking about the garden, you mentioned, I don't, maybe you didn't mention, but weeds in the garden. You need to control the weeds.
And that's probably those mutual funds.
Those are the mutual funds, the bad investments. So you get rid of the weeds, and then you just concentrate on what you want to have growing in that garden. Same thing in these retirement plans. And how do you do that? Well, you have to understand, first of all, what do you have? What's available in that retirement plan, and what might benefit during certain market conditions more so than something else. But since you're already making those decisions, you're already managing them, why not set up something that you control completely? And one of the great things there is that by doing that, you eliminate fees. And we talked about that the last couple of weeks. Just like a 2% fee, a 2% fee by the plan sponsor, by the mutual fund that's in that portfolio, can take, over the course of years, over 30 years or so, can take hundreds of thousands of dollars away from what you could have. And by eliminating the fees, you eliminate that issue. Also, we know the markets don't just go up. They go up, they go down, they go sideways. And the assets that we had talked about before, the leveraged assets, futures, Forex, and options, they will work in all three market or all up and down markets for futures and Forex. Options work in up and down markets and sideways markets, and even markets that are moving up and down. You can have one options trade on, where the asset can move up, down, or sideways, and it still can be profitable. So, and that's where there's a big difference between what the smart money does and what the public does. The smart money is taking advantage of all three directions, not just one out of three directions.
Yeah, and you talk about that up market. Everybody knows that. Everybody says they want to buy low, sell high. And that down market it's called shorting.
Sure.
And shorting basically means you sell it first and you buy it back at a lower price. So essentially you're opening a position as it's high and closing it as it's low, and that difference there is the profit.
Sure.
And that is what a lot of people really like to see, is what are the opportunities in down markets? Because I mean, think of it this way: we had some pretty big down days this week. Well, there's opportunity there. So rather than just sitting on the sidelines and waiting for things to happen, it takes action. Take action to have better confidence, to make better choices in your retirement accounts. And that's what it all comes down to, is those choices. But you want to have the consistency to do that. And it all comes down to having that plan. So let's go, coming up in the next segment here, I do want to continue the discussion about retirement, Al, but we talk a lot about having this plan. So I want to talk more about some of the steps in there, just to really help people understand why it's so important to have consistency, and why that consistency actually helps you build confidence. But I also want to get into why it's so important to have a community of investors that you can bounce ideas off and really help you bring that more of a confident investing decisions. This is Josh and Al with the Retire Young radio show. We will be right back.